Hi, this is Paul Tabor. I'm a CPA and independent financial planner that works with the county as a contractor, helping the employees to manage and plan for their retirement. Today, I'd like to go over a presentation on financial planning, and our focus will be mostly on retirement planning, but also give some helpful tips of things that you can do just from a general financial planning standpoint. As you think about financial planning, to me, it's almost like you're planning for a big vacation, and especially if it's retirement planning, you're planning for a big vacation. And so it's like you're planning for a big trip. To me, to be successful, you have to have 4 different things for a successful retirement. First and foremost, you've got to make a plan. It needs to be as detailed as possible, and certainly as you're getting closer to when you're going to retire, you're going to want to bring even more detail to bear. Second, you're going to need to manage your cash flows. Your role, once you've retired, is going to be, your day-to-day role is going to be managing the different cash flows. First, you're going to have to figure out timing of inflows. When do I start my pension? When do I start Social Security? When do I start taking distributions from a retirement account? Likewise, you're going to need to control your outflows. And that's going to be key because as you go through retirement, one of the things you're going to want to make sure is that you're not spending too much money. You're going to need to invest wisely. Notice that I didn't say to invest conservative. I didn't say to invest aggressive, but I said to invest wisely. Take a look at the time that you're going to be using your money, kind of project out how long you think you're going to live, and invest your funds in a prudent approach that takes into consideration that time horizon. And then certainly preserve what you've accumulated over the years. One of the other presenters, another presentation you'll have access to, deals with estate planning. An attorney gives a presentation on estate planning. I'll also touch on a couple insurance items near the end of my presentation. Recognize that we put the planning process in the shape of a wheel because it's something that's going to continue. It's not a once and done. It's not like I plan and then I'm finished, but it's going to continue as you go through your retirement years. You start off in the upper right-hand corner and you have to know where you are today. And that's really the concept of net worth, identifying those things that you own and identifying those things that you owe and determining what your net worth is. Where do you stand today? You have to then kind of map out, well, where do I want to get to in the future? You then have to decide, well, if I'm at point A and I'm going to point B, what steps do I need to do to get me to that second point? And then you put your plan into process. But life events are going to happen. Things are going to happen that are going to alter your plan. And at that point, you go back to the beginning, you reassess where you are at that future point, do net worth again, identify, are there new steps to get to your new goal? And put that new revised plan into process. Shape of a wheel because it will continue. From the standpoint of your plan, you're close enough to retirement that it really makes it important to start to get more specific. Get detailed numbers of different sources of income. Get a pension estimate if you're in the pension plan. Get a recent statement from your Social Security benefit. If you have an annuity, get a sense of what that annuity is going to pay you in the future. But start to get more detailed numbers as you get closer to your retirement point. From the income standpoint, also try and identify those income sources that are fixed versus those that are variable. Fixed resources will be things like pension, annuity payments, Social Security payments, things that don't change with the market. But they're going to continue no matter what, versus those income items that are variable. And those would include distributions out of retirement plans, other savings and investments. At the same time, take a look at your expenses and try and divide those between those things that are your needs versus those expenses that are your wants. And if at all possible, try to then match those fixed resources, those fixed sources of income with your needs. As you go through your plan and as you move forward, there's 2 key financial reports that I recommend that you do periodically. The first is your net worth statement. In a net worth statement, the concept of net worth is basically taking a snapshot in time. It is a picture at a specific point. And as soon as that picture is taken, things start to change. But the goal here is that you're going to take a picture of your net worth. You're going to identify the market value or the value of your things that you own. You're going to look at what's the outstanding balance on your liabilities. And you're going to determine based on the net of those two what your net worth is at that point in time. The concept then is to review the trends, take successive pictures at periodic points in the future and compare the trends. You can also do this going backwards as well to see what's been the trend up to this point. And you're basically reviewing the trends of your net worth. During your working years, your net worth most likely has been increasing, either because you've been building your investments or because you've been paying down your liabilities, or probably a combination of both. Once you retire, some of you, your net worth may continue to increase. And for you, the planning point there may be needing to do some estate planning. For others, your net worth may level off, and that's okay. And for some of you, your net worth may start to decline over time. And again, that may not be a bad thing, but you just need to project forward and look to see is your net worth declining faster than you need it to make sure that your assets outlive you. The other thing that I would ask that you do is take a look at your liquidity and compare your liquidity from time to time. Your liquidity is basically any investments that you have that are either in cash or a cash equivalent. So I would include in there balances in your checking account, balances in a savings account, balances in a money market, anything that you can access that has no restrictions, no volatility. Basically, you can get it and convert it to cash very quickly. Make sure you've got enough reserves of liquidity while you're reviewing your net worth. The second statement is then a cash flow statement. And here you're basically comparing your current income, those things that are flowing in, versus your expenses going out. Again, do a periodic picture to see what's the trend. You may find that you have a surplus where there's more available or more resources coming in than expenses going out. That's a great thing. That means that you're not overspending your means. You might be break even, which is okay as well, or you may find that your cash flow is a deficit. If it's a deficit, you then need to think about, well, are there some things that we could do to level it off, possibly increasing the income, maybe doing a part-time job, or taking a look at your expenses. The good thing about looking at your cash flow is that it forces you to review your expenses periodically. And in doing so, you can look to see, are there some areas where maybe you're overspending, maybe you can cut back a little bit to help increase your savings. And again, the key here is making sure if you do have a deficit, that you're not going to outspend your assets during your lifetime. So from the standpoint of managing this whole process, I recommend that you computerize it as much as possible, but I'll leave that up to you individually. Some people are very comfortable with computers and computerization, some people are not. Over the years, I've met with people that have very complex plans that are computerized. I've met people that have put together very extensive Excel spreadsheets. I meet with people that have their plan on a yellow pad of paper, and that is fine. To me, it's what works best for you and your family. But I think the more you can computerize the process, I think the easier it becomes. I'm a big fan. Over the years, I've used Quicken considerably for our family, and I'm a big fan of Quicken. But there's others like it. There's a newer software called Mint that people are using. And again, I think it's whatever works best for you and your family. I do recommend over time that you tend to look at your accounts and potentially consolidate things, especially when you get out to the required distribution years, which are out at age 72 and beyond. It's going to be easier to consolidate your accounts a little bit. And I try to keep things as simple as possible, and not overcomplicate planning. From a retirement planning standpoint, a couple different options you have available. Certainly, if you're in it, if you have a Fidelity account, you have access to the Fidelity representative that you can meet with periodically, and you can work on they have a financial planning or a projection tool. If you're in either the retirement savings plan or the Fidelity Deferred Compensation Plan, you can actually meet with me once a year and we can sit down and do some planning as well. But other resources that might be available to you, AARP on their website has a retirement planning tool that you can use. All of these tools, the important factor is the quality of the information going in, because it's the, kind of that old adage that if you're putting good information in, you're going to have good, or at least an accurate result. If you're putting bad information in, you're not going to have an accurate result. So I think the more detailed the information, the more accurate the information, the better the projection will be. As you're doing retirement projections, two assumptions that you need to think about. One is going to be inflation. And at least for the plans that I do, I generally will use a 3% inflation factor. Most recently, we've had inflation less than 3%. Over long-term historical averages, it's usually run about 3%. And again, my preference here is to maybe overstate it a little bit to be conservative in your plan. The other key assumption is life expectancy. How long do you think you're going to live? And here, it's more important to plan for longevity. If something happens and you die sooner than you expected, that doesn't have as much of a dramatic impact on your plan. But if you live longer than you thought, that could be more dramatic. So I would encourage you, especially if you've got some longevity factors, take a look at your health, take a look at your family history. Giving myself as an example, both my parents lived into their mid-90s and were both very active until that point. My dad actually had a grandfather that lived to 101. So for our plan, for my wife and I generally will look at age 100 from a life expectancy standpoint. The averages right now are about 85. So I would encourage you to at least make it 90 if you think you're going to live to the normal life expectancy, and possibly add a little bit more just in case, to cushion that just in case. So let's now turn and talk about some of the sources you're going to have during your retirement years. And basically, what are those resources? What things are going to flow into your pool of resources? Certainly, for some of you, you might be involved in the pension plan. If you are, then you're going to be getting a monthly check that's going to be coming in from the pension plan. Or you might be, from a prior employer, you might have a pension benefit. Other benefits would be other employer plans. So in this category, I'm going to include the retirement savings plan. I'm going to include the guaranteed retirement income plan, or what's known as the GRIP plan. I'd also include the deferred compensation plan. These are basically retirement plans that are sponsored by your employer, and it's going to be a significant resource coming into this pool. Certainly any other investments and savings you have outside of your employer. So in here, I would include checking, savings, investment accounts that are not in a retirement account. I'd also include individual retirement accounts in this category. And then lastly, certainly Social Security benefits. And again, getting a good estimate of your Social Security benefit is important. One resource that's not in this picture, but certainly for some of you becomes a resource, might be future work. Either doing some consulting, doing some part-time work, taking a hobby and developing it into a business, whatever it might be, but that for some of you may also be a resource. I'm going to step back for a second and talk about the pensions for just a second, and encourage you that if you're going to be looking at different payout options with the pension or with an annuity, if you have an annuity outside of the county, for example. If you're married, I would encourage you to look at the joint survivor options. Recognize that the single life option looks very attractive in terms of the monthly amount that you're going to be getting. But also, if something happens to you, generally speaking, once you've passed away, that benefit would stop. So I would encourage people that are certainly in married couples, take a look at the joint survivor options and make sure that you're planning for the future for both of you in the couple. Okay. As you think about your retirement income sources, this slide, I break it down into two columns. The left column represents the time between now and when you turn 72. And the right column is then once you've turned 72, at that point, the required minimum distributions will start. And if you notice, that's the first thing that I've put at the top of the right column is the required minimum distribution. Otherwise, the two columns are the same. And you might be saying, well, wait a second, I thought that this required distribution stuff started at age 70 and a half. And you're right, it used to, but the Secure Act, which started back in late 2019, changed the required distribution rules, and they're now required to start in the year that you turn age 72. Okay? Basically, the required minimum distribution applies to any amount that you have in a tax deferred account. So that would include money that you have in the retirement savings plan. That would include money that you have in the pre-tax portion of the deferred compensation plan. That would also include money you have in traditional IRAs. Anything that you are deferring the tax into the future falls under the purview of the required minimum distribution rules. If you're still working at age 72, you can delay the start of your distributions of the required distributions from your county-related plans, but any other outside investments that you have in tax-deferred accounts, the rule would still apply at age 72, okay? So you have to be a little bit careful, but if you are still working, and if you're not a county employee, if you're an employee anywhere where you have an employer plan, if that employer has adopted the ability for you to delay the start, then you certainly can. You don't have to start it because you're still working. The thing you have to be careful about, though, and this may have an impact on timing of retirement. If you decide to retire at any point during a year after you've turned 72, even if it's on December 31st, you will have a required distribution for that year. So you have to be a little careful if you're thinking, well, I'm going to retire near the end of the calendar year, and by doing that, I'm going to be able to avoid the RMD for that year. You may not. And so what may be beneficial is maybe delay your retirement start until January of the following year, and that way you can push the required distribution off to that next year. Also recognize the rules are different if you inherit an IRA or if you inherit a retirement account. The required minimum distribution rules are totally different than the retirement rules. And basically, if you inherit an IRA, if you're not a spouse and you inherit an IRA, you now have a period of time of 10 years to completely distribute out the account. So the rules are a little bit different on required distributions for retirement accounts versus inherited accounts. Okay. The key is, you need to make sure that you're meeting this required distribution. In the first year, it generally represents about 4% of your account value. If you don't take out the minimum in a year, whatever portion you should have taken out but you didn't, there's a 50% tax penalty. So you definitely have to make sure that you're meeting the required minimum distribution each year. The good thing is that the custodians that hold your retirement accounts know your date of birth, they know your account value, so they can calculate and tell you what your required distribution will be. And that way you can make sure that you, by the end of that calendar year, have taken out enough to meet the minimum. You can always take out more, but you certainly need to take out enough to meet the minimum. The different benefits that you have through Montgomery County, the first three on this list to me are your base, what I call your base retirement accounts. Some of you are in the pension plan, some of you are in the retirement savings plan, and some of you are in the guaranteed retirement income plan. To me, those are your base or your kind of foundation retirement accounts. The other account on this list is what's called a deferred compensation plan. And all employees are eligible to participate in the deferred compensation plan. With the deferred compensation plan, you're basically electing to take some of your salary and invest it for the future to increase your retirement savings. In the deferred compensation plan, you can choose whether you put money in a pre-tax basis. It then grows tax deferred but in the future, as you're taking it out, it's then taxable income, subject to the required minimum distribution rule. Or you can, in the deferred compensation plan, you can elect to put the money in after-tax dollars in a Roth investment, which would then still grow tax deferred, but in the future, as you're pulling funds out, as long as you're at least 59 and a half, and the account's been, and you've funded Roth money for at least 5 years, or you've left it alone for at least 5 years, at that point, as you're taking distributions on the Roth side, the growth in that account is tax-free. So you have that option within the deferred compensation plan, and all employees are eligible to participate in this plan. The maximum amount that you could fund into the deferred compensation plan for 2021 is $26,000. And that's combined Roth or pre-tax, okay? That does include the catch-up for people that are age 50 and over. So that's the maximum that can be funded in 2021. Now, if you're, and this is special with a deferred compensation plan, if you're within the last 3 years prior to your retirement and you've not fully funded the deferred compensation plan during your years of work, there is a calculation that can be done, and the custodian, either Fidelity or Empower Retirement, depending on which plan you're in, they need to do the calculation, but they can determine how much additional in those last 3 years you can fund, and you can even fund for this over and above the $26,000. The current limit right now is about $35,000 that you could fund during those last 3-year period. And it just depends on whether you've fully funded the account during your earlier years. I encourage everyone, if your circumstances are such that you have additional funds that you can save for retirement, I encourage everyone to take advantage of the deferred compensation plan. So then the question becomes, well, what happens to the money that's in my different savings plans at the point that I decide to retire and leave the county? What are the options that I have with that money? And first and foremost, and one that I recommend to everyone, even if it's just temporarily, is leave the money in the plan. There is no requirement, there's no deadline, there's nothing that says you have to take money out of the retirement plan when you leave the county. And certainly if the balance is worth more than $1,000, they can't require you to actually close the account at that point. So you have the ability to leave the money in the plan. If it was properly invested, good asset allocation, the day before you retire, nothing has changed the day after you retire that would warrant having to move the money, okay? So I recommend for everyone, don't rush the process. You're starting a whole new chapter in your life at that point. Let some other things kind of settle in. You can come back 3 months later, 6 months later, whenever is convenient, and decide to transfer the money if that's in your best interest. When you do that, most people would do a rollover to an individual retirement account. And I recommend that you do a trustee to trustee transfer, where the money is transferred over to the new custodian, either directly by wire transfer or by check, but the check is payable to that new custodian. That way, Montgomery County doesn't have to withhold any taxes, and the transfer is a lot easier to do. The other option you have available to you is certainly you could withdraw funds from the account. The money, once you've retired, once you've separated from service with the county, within a couple of weeks, Fidelity's notified or Empower Retirement is notified that you're no longer an active employee, and they record in their records that you have access then at that point to come in and withdraw your funds if you wish, okay? Just recognize that if you are going to withdraw your funds, or ultimately when you use the funds, you're going to have to be careful about the taxes, okay? So from a tax perspective, money that's in a tax deferred account, so pre-tax funds, money in a retirement savings plan, money in the pre-tax deferred compensation plan, or a traditional IRA, ultimately in the future, when you start spending or pulling that money out, no matter when you pull it out, it's going to be subject to income tax. It's going to be subject to federal and state tax at that point, and it depends on during that calendar year, whatever you pull out is going to be taxable income for that calendar year. Current, and by the way, it's going to be ordinary income. It's not capital gain income. Current ordinary income rates start at 10% and go up. Right now, the highest is 37%. So you just have to be careful as you're drawing money out and recognize that it will be subject to tax. From a state tax standpoint, it's not subject to state tax based on where you lived when the money went into the account, but it's where you live when you're taking money out. So if you're a Maryland resident in the future and you're taking money out of your tax deferred account, not only will you have to pay federal tax, but you'll pay Maryland tax as well. If you're a resident of another state, it's going to depend on that state's income tax rules as to how the distribution would then be taxed. So for example, if you lived in the future in Florida or Tennessee or one of the states that don't have an income tax, you'll still have to pay federal tax, but you won't have to pay any state income tax on the distributions coming out. So just be careful, in terms of tax planning, recognize that you're never going to avoid the tax on this money. And in fact, even if someone inherits a pre-tax account in the future, as they're taking it out, it will be taxable income to them as well. So just make sure you're recognizing the taxes. And then also, depending on your age, you have to make sure that you're not also tripping up with an early withdrawal penalty. Generally speaking, if you're taking money out of a pre-tax account prior to age 59 and a half, not only is it taxable, but it will also be, there's an additional 10% penalty. Now, first and foremost, money that you've put into the deferred compensation plan doesn't have this 10% penalty rule. So you can take distributions out of that plan prior to 59 and a half. If it's pre-tax money, it will still be taxable, but there won't be a penalty. So you just have to be careful. There are some other exceptions to the 10% penalty rule, but generally speaking, if you're taking money out of a retirement account prior to 59 and a half, you may have a 10% penalty as well that you have to be careful about. So I just, take your time in taking distributions and manage the taxes as much as possible. Turning now to Social Security and managing that part of your plan, as you're working through your working years, the main thing that you can do to manage your plan is to sign up for your online access with Social Security at ssa.gov and periodically get an earnings statement and periodically check the earnings record to make sure that there's not any errors in what's getting posted into your earnings record. Ultimately, your benefit under Social Security is going to depend on your earnings record. And right now, the rules are that they take your entire record, they take the highest 35 years out of the record. They don't have to be consecutive. For most people, they usually are, but they're going to pick and choose the highest 35 and use those to calculate your benefit for your Social Security benefit. So if there's an error in your record, let's say there's a year where you worked and the record for Social Security shows 0 earnings, if you can go back and get that corrected, that may impact or may increase your benefit a little bit. So right now, main thing that you can do to manage your overall Social Security benefit is just periodically review your record. The other thing that's going to then be a question in the future is, well, when do I start Social Security? Under current rules, the earliest that you can start is age 62. The latest that you could defer to is age 70. And somewhere in between, there's going to be an age that's going to be what's called your full retirement age. This used to be age 65. They then increased it up to age 66. And it's now, depending on what year you were born, it's now age 67. So anyone that was born in 1960 and more recently, their full retirement age is 67. If you were born in the first half of the 50s, your retirement age is 66. And if you were born sometime between 1955 and 1959, that was kind of a transition period. Your full retirement age is going to be 66 in a certain number of months. I was born in 1959, so mine is 66 in 10 months. The key to the full retirement age is that if you start benefits prior to that point, they're going to apply a discount. And the farther back, the sooner you start, the more discount they're going to apply. And that discount is going to apply for the rest of your life. For most people, Generally speaking, I'll recommend that people wait to their full retirement age. But what you're really trying to assess with this is how long do you think you're going to live? And what you're looking at is, again, those factors of longevity and your health to try and identify how long do I think I'm going to live? If you think you're going to live to your normal life expectancy and you don't need the funds earlier, then my suggestion for most people is you wait to your full retirement age. There is a whole nother presentation available to you that gets into a lot more detail on Social Security. And I would encourage you, if you have questions on Social Security, to really take some time and go through that presentation as well. I mentioned back on the slide for the deferred comp, I mentioned about the Roth feature or the Roth bucket that's inside the deferred comp account. You also have, as another option, possibly funding Roth IRAs. Now, again, comparing the Roth IRA to a traditional IRA, the Roth IRA, the only kind of contributions that can go in are after-tax contributions. The money in that account grows tax deferred. Nothing happens if you don't take it out. And then ultimately, if you are older than 59 and a half and you've had the investment in Roth for at least 5 years, when you do decide to take it out, the income, the growth on that would be tax-free. Also, it's not subject to the required distribution rules that start at age 72. So you can leave money in Roth accounts into your 70s and 80s. It can even be passed on to your descendants, and ultimately they would inherit a Roth IRA. The limitation on Roth IRAs is that if your income, if you're married and your income is above $198,000, then your ability to fund Roth IRAs have phased out. And so for people in the higher income categories, the Roth IRA may not even be available to you. The one key benefit of that deferred comp account Roth feature is that there is no income limit. So for those of you that may be limited to funding Roth IRAs, you still can fund the Roth deferred comp to be able to build your Roth dollars. And I highly recommend investing some Roth money as you go along, okay? The limitation in terms of funding to the Roth in 2021 is $7,000 in total. And that's a big difference between the deferred comp versus the IRA. The deferred comp, you could do $26,000, the IRA, it's only $7,000. So you just have to, it's another planning tool that you can think about. And again, if you don't have any Roth dollars invested, I recommend trying to get some. It just gives you flexibility in the future that once you retire, you'll have not only diversification of the types of investments you have, but also the types of accounts you have as well. And that's a good thing. As you think about your your day-to-day cash management, my suggestion is that you have your income go into an account that's earning as best an interest rate right now as possible. No one's paying a lot of interest at this point, but certainly there are some accounts that will pay a little bit better, and I recommend you try and keep your reserves in that type of an account. I do recommend, from a reserve standpoint, that during your working years, I recommend that people keep 3 to 6 months of living expenses net of your recurring income. So if you have any fixed sources of income coming in, subtract your expenses by that first. The net amount of your expenses, I recommend still having 3 to 6 months of living expenses set aside. As you're getting closer to retirement and as you're getting into your retirement years, I prefer you actually have 2 years worth of living expenses set aside. And that way you can ride through most ups and downs in the investment market. To maintain that reserve account, my recommendation is that you look at an online savings accounts or a money market or a credit union. Right now, the online savings accounts tend to pay a little bit better interest. If you Google the phrase online savings accounts, typically the 4th or 5th item down is a reference to high yield online savings, and it has in the title the reference to Nerd Wallet. If you look at that, click on that and look at the account on that site, Nerd Wallet does kind of an ongoing review of these online savings accounts, and that's a good way to take a look at some of the different alternatives. Most are FDIC insured, just like your brick and mortar or your normal bank. They have the same FDIC insurance, but look for that feature as you're taking a look. But keep your money, your reserve money, in as much of your reserve money in an interest-bearing account as possible. From the standpoint of managing your debt, I do recommend that you try to pay off your credit cards. And in fact, for some of you, if you're carrying credit card balances that have high interest rates, it may actually be preferable to pay those off versus putting money into the deferred comp account. But certainly try and pay those off as you get closer and closer towards retirement. There's two schools of thought in terms of how to pay them off. One is rank them based on the size of the account, pay off the small ones first, because it's giving you that psychological boost that you recognize you're making progress. And although that's a good approach, I actually prefer that you rank them based on the interest rates that you're paying and pay off the most expensive ones first. But again, whatever method works best for you, but try and pay off as much of your credit card or your high interest rate debt, pay that off as much as possible as quickly as you can. In terms of paying off your mortgage, it really comes down to both a financial analysis and also a psychological portion. The financial analysis, or the financial reason, you basically are comparing the interest rate that you're being charged on your mortgage versus the rate of return that you're making on the money that you would use to pay the mortgage off. Because interest rates are so low right now, even though mortgage rates are low, interest rates on savings are even lower. And so it still may be beneficial to pay off your mortgage depending on the difference between the interest rates. The other thing that I look at is the psychological reason. For some people, it's extremely important that when they retire, they no longer have a mortgage to pay. Others, it's really not a big deal. And it depends, each of you are individually different. And I would encourage you to think about that factor as well. If it's certainly a strong reason or strong factor that you want to make sure it's paid off, then even if your rate of return that you're paying on the mortgage is slightly different than the cost, it still may be beneficial to pay it off early, okay? But each of you are a little bit different, so I would encourage you to go through that quick analysis just to be sure. In terms of wealth preservation, again, I mentioned to you there's a completely separate presentation on estate planning, and I encourage you to watch that presentation as well, because there's some things you can do and should do to preserve your assets based on your estate plan. From an insurance standpoint, two key types of insurance that I recommend that people at least consider. The one is long-term care insurance, and the other one is to have an umbrella liability policy. Long-term care insurance would cover the need if you have to go into either assisted living or skilled nursing care, or possibly have home health care. The premiums can be quite expensive, so a lot of people are a little bit put off by that, but I would encourage you to at least consider it. If you're doing some shopping for a long-term care policy, go to the National Association of Insurance Commissioners website, which is www.naic.org. And on their website, they have a shopper's guide to long-term care. It's pretty extensive. It's probably about 60 pages long, so it is a pretty extensive guide. But I would encourage you to take a look at that. It explains some of the features and some of the different characteristics of long-term care policies, and it may be helpful to understand them better when you do decide to take a look at those different types of policies. From the other standpoint, I recommend that people have an umbrella liability insurance policy. And basically, with your homeowners and your auto, there's two parts to those coverages. There's the property coverage and there's a liability coverage. The liability coverage is there that if you're ever sued and someone is successful in suing you because of neglect, they can, that whatever the policy limit is in the underlying policy would be paid out first, but then they'd have access to your other investments and assets. And so you have potentially some exposure. An umbrella policy, as the name implies, forms an umbrella over your auto and your homeowners. It doesn't add to the property portion, but it does add to the liability portion. They come in $1 million increments, and they have a fairly, for $1 million policy, the premium, the annual premium is relatively inexpensive. Most carriers, it's in the $250 to $350 price range. So for a little bit more money each month, you can have substantially more liability protection. And I encourage people if they don't have an umbrella, or some carriers call them excess liability policies, I would encourage you to talk to your property and casualty agent and see if that's something that you can add. Most insurance companies, if you get all the different policies through them, they might bundle the premiums. So you may end up saving a little bit on the premiums by doing that as well. So we spent a good bit of time today talking about, overall retirement planning, but some overall financial planning concepts. In terms of your next steps at this point, I think it's important to take an inventory of where you are today. Again, if you've not done a net worth statement in the past, do a net worth statement. What are the things that you own? What are those things that you owe? Take a look at your cash flow. Look to see, are you saving each year? Are you overspending? Are there some areas where you could possibly cut back and save a little bit more? And develop your plan. If you don't have one, spend some time developing a plan. Get as much information as possible and take advantage of all the different resources that the county offers you. There's different seminars, different recordings that you can listen to. There's also some, Zoom seminars and stuff that you can, attend. So take advantage of all those different resources and information that you have available. Certainly talk to your coworkers, talk to your family members, talk to others, get information from a variety of sources, but recognize and make sure that whatever you're getting, filter it with the filter that you need to make sure it's right for you and your family. What may be best for a coworker, for example, may not be the best thing for you and your family. And so you need to filter this information through a lens where you're looking at what's best for you and your family. And then lastly, and certainly potentially most importantly, don't rush your decisions. Take your time. Really think through what you're doing, especially in the pension world. Think through the payout option you're selecting. Once that's decided and you've recorded that decision and it's gone through the rescission period, that part can't be changed. So I would encourage you, in some of the other decisions you're making about retirement,